Welcome back, my friends. Can anyone really predict how interest rates will go and what it means for U.S. Treasury yields and the stock market? No, but there are a lot of self-proclaimed experts on financial TV shows and videos who think they can. Today, 10-year Treasury yield jumps above 4% after Fed official indicates rate cuts may take time. If you believe the so-called market consensus, there are anywhere from 3 to 6 interest rate cuts baked into expectations for 2024. But suddenly inflation is rearing its ugly head again, and not everyone is so confident in rate cuts, or that the Federal Reserve is done with interest rate increases. But before we get into all of that, I would like to thank everyone who views my videos. If you would like to support the channel, please see the link to buy me a coffee in the video description below. And please hit the like button and leave me a comment below. I would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Treasury yields rose on Tuesday to kick off a shortened trading week after Fed commentary indicated the central bank make lower rates at a slower rate than the market had anticipated. The yield on the 10-year Treasury note gained nearly 12 basis points to 4.66%. It had been hovering around the 4% mark for much of last week. The 2-year Treasury yield rose by around 10 basis points to trade at 4.228%. Yields and prices move in opposite directions. 1 basis point equals 0.01%. Tuesday's jump in yields comes after comments from Federal Reserve Governor Christopher Waller suggested that while the central bank will likely cut rates this year, it may take its time during the process. When the time is right to begin lowering rates, I believe it can and should be lowered methodically and carefully, he added. In many previous cycles, they cut rates reactively and did so quickly and often by large amounts. This cycle, however, I see no reason to move as quickly or cut as rapidly as in the past. Investors are looking ahead to December retail sales data out Wednesday, which could fuel recessionary fears and concerns about economic growth if U.S. consumer spending cools. Economists polled by FactSet anticipate an increase of 0.2% for the month, slightly under the 0.3% increase in November. Stocks were down as the 10-year Treasury broke above 4%. Typically, if Treasury yields increase, it means expectations are leaning toward higher interest rates for longer. So, stock valuations tend to go down in unison. Central bank officials pushed against market hopes for a quick monetary pivot. But these days, it seems as though practically everyone is hoping for lower interest rates, especially stock investors. Bank equities gained on better-than-expected earnings results. But, while this means that banks are generally stronger, better earnings have been accompanied by lower lending revenues because fewer individuals and companies are borrowing. So it is fair to say that the banking industry is getting smaller, at least for a few quarters. Banks are keeping their earnings per share rising by laying off employees and closing bank branches. U.S. stocks fell Tuesday as bond yields rose and investors await further data to inform the outlook for Federal Reserve policy. The 10-year Treasury yield jumped over 7 basis points, taking it above the 4% threshold. That's as foreign policymakers at the World Economic Forum signaled further hawkishness, with European central banks François Villeroy de Gallau citing that inflation hasn't yet been tamed. As to U.S. policy, investors will be watching for Fed Governor Christopher Waller's Tuesday speech for further clues. Still, equity losses were paired by solid bank earnings, with shares in Goldman Sachs and Morgan Stanley both gaining ground on better-than-expected results. U.S. Treasury yields across the yield curve climbed to 5-week highs as the 10-year note rose to 429%, while the 30-year bond jumped as high as 4.344% on investors adhering to the U.S. Federal Reserve, Fed, higher for longer mantra. Consequently, that sponsored a leg up in the greenback, USD, though paired some of its gain, clings to minuscule gains of 0.05% at 103.38. To some extent, stock investors are adopting the higher for longer mantra as U.S. 2-year yields skyrocketed. U.S. retail sales for December showed an increase of 0.6%, surpassing both the forecasted rise of 0.4% and the figures from November. This is an indication that the consumers are still spending generously and that inflation might still persist. Later, the U.S. Federal Reserve reported a modest improvement in industrial production, which grew by 0.1%. This marks a positive shift after a period of contraction and stagnation in October and November of the previous year. In addition to that, earlier data revealed during the European session revealed that the UK's inflation exceeded forecasts, sparking a jump in global bond yields. At the beginning of the week, investors were expecting 175 basis points of rate cuts by the Fed in 2024. But throughout the session, they adjusted their bets and now expect 145 basis points of monetary easing, which means they trimmed one rate cut. This could actually just be the start of several months of adjusting expectations. On Tuesday, Federal Reserve Governor Christopher Waller said the Fed is not in a hurry to ease its monetary policy, as inflation is within striking distance of their target. While he is open to the idea of reducing interest rates, Waller cautioned that any such policy changes need to be carefully calibrated and not rushed, emphasizing the importance of waiting until the risks of inflation reigniting have significantly diminished. The U.S. 10-year Treasury note climbed 4 basis points up to 4.106%, while the 30-year bond rose 5 basis points toward 4.344%, before retreating to 4.323%. Meanwhile, the diversion of the U.S. 10s-2s yield curve halted as the 2-year Treasury note climbed 13 basis points of expectations that the Fed would remain reluctant to ease policy as the markets expected. Ahead of the week, the U.S. economic docket will feature U.S. initial jobless claims, and further Fed speakers will cross the wires on Thursday, followed by Friday's University of Michigan, UOM, consumer sentiment. We will see what the data reports show for the rest of the week. But what do you think? Please hit the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. And before we end, a word from the sponsor of this video. Today's sponsor is ProWorldNet.com. ProWorldNet.com is a job website specifically dedicated to licensed professions. Doctors, including any type of specialty, nurses, and that includes all grades of nurses, lawyers, regardless of area of legal focus, teachers and professors, from kindergarten through graduate school, as well as any kind of job that requires a government license or certification. And ProWorldNet.com also includes short-term gig-type jobs as well. So be sure to check out ProWorldNet.com if you are looking for a job or an employee. Thank you for watching.